Let me ask you something. If one of the richest and smartest investors in the world quietly changed how billions of dollars are invested, would you want to know? Because that's exactly what just happened, and almost nobody is talking about it. A few weeks ago, while most people were focused on headlines about inflation, interest rates, and artificial intelligence, a small document appeared on a government website. It wasn't a press release. It wasn't an interview. It wasn't a breaking news alert. It was a routine financial filing, the kind most people ignore. But inside that document was a signal about how Bill Gates is changing his view of the market. And what he's doing right now should get your attention. Every 3 months, large investment managers in the United States are required to report what they own. These reports are called 13F filings. They show which stocks are being bought, which ones are being sold, and how portfolios are changing. Most of the time, these filings are boring. Small adjustments, minor rebalancing, nothing dramatic. But this time was different, because when analysts looked at the latest filing from the Gates Foundation Trust, they noticed something unusual. Bill Gates had significantly reduced his exposure to Microsoft, the company he helped build, the company that made him wealthy, the company he has supported for decades. This wasn't a small trim. This wasn't routine diversification. It was a major shift, and it raised an important question. Why now? Let's be clear about something. Bill Gates is not a trader. He doesn't chase trends. He doesn't react to short-term headlines. He thinks in decades, not months. Every major move he makes is based on research, data, and long-term planning. So when someone like Gates changes direction, it's never random, it's deliberate, it's calculated, and it usually reflects how he sees the future. Over the past year, the Gates Foundation has been slowly reshaping its portfolio, reducing exposure to high-growth technology stocks, increasing exposure to stable, cash-generating businesses, and building more defensive positions, companies involved in infrastructure, transportation, waste management, and diversified conglomerates. These are not exciting stocks. They don't dominate social media. They don't promise explosive growth, but they do one thing very well. They survive in good times and bad. Now, some people will say, this is just normal portfolio management. This is just about funding charity. This doesn't mean anything. And yes, part of that is true. The Gates Foundation does sell assets to fund its work. But here's the key point. It's not just that he's selling, it's what he's selling and what he's buying instead. That's where the message is. At the same time, Gates has been reducing tech exposure. Other major investors have been doing something similar. Warren Buffett has been holding record amounts of cash. Large insiders have been selling more than they're buying. And major funds have been becoming more selective. This is not panic. It's preparation. It's risk management. It's experienced investors adjusting to a changing environment. And this matters for you because most people are still positioned for a world where growth is easy, where markets rise smoothly, where technology keeps outperforming, where risks stay in the background. But Gates' actions suggest something different. They suggest that uncertainty is increasing, that volatility is becoming more likely, and that stability is becoming more valuable. So the real question is not, is Bill Gates predicting a crash? That's the wrong question. The real question is, what kind of market is he preparing for? And what does that tell us about the next few years? To answer that, we need to look deeper. We need to look at what's happening across the market, how valuations are changing, how companies are spending, how debt is being refinanced, and how smart money is positioning itself. Because when you connect all the pieces, a clear picture starts to form. And that picture explains why Gates is shifting his strategy right now. To understand why Bill Gates and other major investors are becoming more cautious, we need to look at what's happening beneath the surface of the market. Because on the outside, everything still looks fine. Stock indexes are near record levels. Technology companies continue to dominate headlines. Artificial intelligence is being promoted as the next major revolution. But when you look closer, the picture becomes more complicated. And that's where smart money focuses. Let's start with valuations. Today, many of the largest companies in the market are trading at historically high prices compared to their earnings. In simple terms, investors are paying a lot for each dollar of profit. That can make sense when growth is strong and stable. But it becomes risky when growth starts slowing. Right now, a small group of companies carries a huge share of the market's value. A handful of tech giants represent nearly a third of the entire index. That level of concentration is rare. It means that if just a few major companies struggle, the whole market feels it, and experienced investors know this creates fragility. Next, look at corporate spending. Over the past 2 years, major technology companies have invested hundreds of billions of dollars into artificial intelligence, data centers, servers, specialized chips, and energy infrastructure. These investments are massive, and they are long-term bets. The problem is that many of these AI projects are still not producing strong profits. They are impressive, they are innovative, but they are expensive, and returns are uncertain. If AI delivers, these companies win big. If it doesn't, margins suffer. And when margins suffer, stock prices adjust. People like Gates understand this risk very well. They've seen technology cycles before. They know not every breakthrough becomes a profitable business. Now let's talk about interest rates and debt. During the years of near zero interest rates, companies borrowed heavily. Money was cheap, loans were easy, refinancing was painless. But that era is over. Today, interest rates are much higher. Debt that once cost very little to maintain now costs much more. For highly leveraged companies, that's a major change. Interest expenses rise, cash flow tightens, flexibility disappears. Some companies can handle this, others can't, and investors with access to deep financial data can already see where stress is building. Another important signal comes from insider behavior. Corporate executives, board members, and major shareholders know their businesses better than anyone. They see sales trends, they see cost pressures, they see future risks. When insiders are confident, they tend to buy. When they are cautious, they tend to sell. Over the past year, insider selling has been consistently higher than insider buying. Not in one sector, not in one company, across many industries. That doesn't mean disaster, but it does mean caution. Now look at Warren Buffett. Buffett is famous for staying invested. He dislikes holding cash, he prefers owning businesses. Yet today, Berkshire Hathaway is holding hundreds of billions of dollars in cash and short-term government bonds. That is not accidental. That is not laziness. That is positioning. Cash gives flexibility. Cash gives patience. Cash gives opportunity. It allows you to act when others can't. Gates' increasing exposure to Berkshire is not just about Buffett's reputation. It's about gaining access to that defensive structure. Another factor is economic momentum. Growth in many developed economies is slowing. Consumers are becoming more careful. Debt levels are high. Savings are lower. Businesses are more selective with hiring. None of this means collapse, but it does mean the environment is changing. The easy growth phase is ending, and a more complex phase is beginning. This is where experienced investors adjust. They don't wait for headlines. They don't wait for recessions to be announced. They move when conditions start shifting, when risks become unbalanced, when upside becomes limited and downside becomes larger. That's what we're seeing now. And this explains Gates' portfolio changes. He's not abandoning technology. He's not betting against innovation. He's reducing exposure to areas where expectations are extremely high and increasing exposure to areas where stability matters more than excitement. Railroads, utilities, waste services, diversified businesses. These companies don't depend on hype. They depend on real-world demand. People still ship goods in recessions. People still generate waste. People still use electricity. That's predictable. That's valuable in uncertain times. So when you connect everything, valuations, debt, AI spending, insider behavior, and cash positions, a pattern emerges. It's not fear. It's realism. It's preparation. It's recognizing that markets move in cycles and that we may be entering a more volatile phase. Now the question becomes personal. What does this mean for you? For your savings, for your retirement, for your investments? Because understanding what Gates is doing is only useful if you know how to apply it to your own situation. And that's what we'll talk about next. Now let's talk about what all of this means for you. Because understanding what Bill Gates and other major investors are doing is interesting, but it only becomes valuable when you connect it to your own financial life. Most people today are heavily exposed to the stock market without even realizing it. Through retirement accounts, index funds, pension plans, and savings programs, many portfolios are concentrated in the same large technology companies that have driven the market higher over the past decade. That worked very well during a period of low interest rates and strong growth. But when conditions change, concentration becomes a risk, and that's what Gates' strategy highlights. Not fear, not pessimism, risk awareness. He is reducing dependence on one sector. He is increasing balance. He is building resilience. That's a lesson, not a prediction. It doesn't mean you should sell everything. It doesn't mean a crash is guaranteed. And it doesn't mean growth is finished. It means uncertainty is rising. And when uncertainty rises, smart investors adjust. One of the first things this suggests is the importance of diversification. If most of your money is tied to one industry, one theme, or one group of companies, your results depend on things you can't control. Balancing growth assets with stable assets reduces that risk. Another lesson is liquidity. Cash is often underestimated. People think of it as unproductive. But in uncertain periods, cash is flexibility. It allows you to respond instead of react. It allows you to invest when opportunities appear. It gives you peace of mind. That doesn't mean holding large amounts of idle money forever. It means maintaining enough liquidity so that short-term market movements don't force bad decisions. Another key point is discipline. Gates and Buffett don't chase headlines. They don't react emotionally. They follow structured processes. They analyze data. They plan for multiple scenarios. That mindset matters more than any single investment. When markets rise quickly, it's easy to become overconfident. When markets fall, it's easy to panic. Both reactions are costly. Long-term success comes from consistency, not excitement. It's also important to avoid extreme behavior. Don't try to time every move. Don't try to predict every turning point. And don't copy any investor blindly, no matter how successful they are. Gates' strategy works for him because it fits his goals, resources, and time horizon. Your strategy should fit yours. What you can take from this is the principle, not the exact portfolio. Focus on quality, focus on balance, focus on sustainability. Another lesson is education. Investors who understand history tend to make better decisions. Markets have always gone through cycles. Booms are followed by slowdowns. Innovation is followed by consolidation. Optimism is followed by caution. None of this is new. What changes is the speed, the scale, and the technology involved. By studying past cycles, you learn that volatility is normal. Corrections are normal. Uncertainty is normal. What matters is how you respond. Finally, there is the question of mindset. Gates' recent moves show long-term thinking. He is not trying to maximize short-term returns. He is trying to protect long-term impact. That's a powerful approach. It reminds us that investing is not about winning every year. It's about staying in the game for decades. Protecting capital matters. Preserving flexibility matters. Avoiding irreversible mistakes matters. Growth comes after that. So when you see major investors shifting their strategies, don't interpret it as a warning siren. Interpret it as a reminder to review your plan, a reminder to manage risk, a reminder to think beyond headlines. Because markets will always change, technologies will rise and fall, narratives will come and go, but disciplined investors who adapt intelligently tend to survive and succeed. That's what Bill Gates is doing right now, not predicting the future, preparing for it, and that is something every serious investor can learn from. Thank you for watching. If you found this breakdown useful, make sure to like the video, subscribe to the channel, and share it with someone who cares about understanding the market, not just reacting to it. I'll see you in the next one.